Hi guys, welcome back to Father and Son Investing. There's been a lot of talk this year about the Fed lowering interest rates. So far, that's all it's been is talk. In fact, at the beginning of the year, the market was expecting 6 Fed rate cuts, even though the Fed was saying they only expected 3. That's kind of what the market does. However, after this last Fed meeting here in June, the expectation from the Fed is only 1 rate cut this year. So this video is going to ask and answer the question, what happens to my Treasury bill, note, or bond if the Fed lowers interest rates this year? So let's get started. In order to answer the main question, I'm going to ask 4 additional questions here to help us find out what happens to our U.S. Treasuries if the Fed lowers interest rates. I'll try to address these first in Treasury bills and then Treasury notes and bonds because they behave and are purchased differently. Let's go ahead and ask the first question. Can the U.S. Treasury force you to sell your Treasury bill, note, or bond if interest rates decrease? The answer to that is currently no. That would be called a callable bond, and the United States Treasury has not sold callable bonds since 1984. However, you'll notice here that this presentation from the Treasury Borrowing Advisory Committee, that's what TBAC stands for, one of the options that they have looked into in order to increase the number of people who might be interested in purchasing U.S. Treasuries is the bringing back callable bonds. Now, why might the Treasury be interested in bringing back callable bonds? Well, first of all, it's actually quite a big market. The outstanding agency callable bond market right now is $750 billion. If you're not interested with agency callable bonds, we've done a couple of videos on that. I would encourage you to watch them. The other reason that the Treasury might be interested in doing this is that they would be able to lower their overall interest rate that they would be paying if they were to issue callable bonds at this higher rate now, and then the Fed starts lowering interest rates. Now, why might a person like you or I be interested in purchasing a Fed callable bond? Well, that would have to do with being able to get a little bit more interest out of the Fed. However, realize that you're also facing some interest rate risk having to do with the Fed, the Treasury, calling the bond in early and you being unable to repurchase a similar bond at a similar interest rate. Just for gee whiz, this gives you some idea of how the Treasury has used callable bonds since 1917. You can look there and get an idea of how often this has come about. The second question is, what happens to the coupon on your Treasury note or bond? Notice I didn't say Treasury bill on this because Treasury bills are 0 coupon bonds. You purchase them at a discount and then receive the face value of the Treasury bill when it reaches maturity. What happens to the coupon on a Treasury note or bond? The coupon is the interest payment that you're receiving from the U.S. Treasury. In this case, it's every 6 months. That coupon will stay the same. Regardless of what the new interest rates become, the amount of money that actually goes into your bank account will stay the same. Now I bring this topic up because it's important to know that if you are purchasing a Treasury note or bond on the secondary market, you need to pay attention to what the actual coupon payment is, because that's what's going to be going into your account every 6 months. Obviously, you do want to pay attention to that yield to maturity to understand whether you're getting a good deal, but it's the actual coupon that you need to know how much money you're going to be receiving. All right, let's move on to the third question. And in order to get to actually the third and fourth question, I need to explain one very basic principle about bonds. Hopefully you know by now that as interest rates go up, bond prices go down, and the opposite is true as well. As interest rates go down, bond prices go up. Why is that? Let's just use an example. Let's say that you hold a bond that you purchased at a 3% interest rate, meaning you were getting 3% back annually. If current interest rates for a similar bond are, say, 4.25%, then you would need to lower the price if you wanted to sell it in order to make that yield to maturity similar to that 4.25% that a person could get if they bought a bond today. The opposite holds true if you hold a bond that's currently yielding 4.25% and interest rates go down. Well, then you can demand a little more money than you paid for it. Now let's go ahead and address the third question with that concept in mind related to interest rates and bond prices. How would you figure out the price of a zero coupon bond? That's a Treasury bill is a zero coupon bond. It doesn't pay a coupon. You buy it at a discount. How would you figure out the price, the new price of your Treasury bill? Well, the formula for figuring out the price of a Treasury bill in a very simplified way is the maturity value, or the par value, or the face value of that Treasury bill, divided by 1 plus R. R in this case is the required rate of interest, or essentially the new rate of interest if interest rates go down. And N is the time until maturity in years. Remember that Treasury bills are only up to 1 year, so you might be putting in here 1 or some fraction of 1. Now, you certainly could go ahead and try to use that formula if you want, but rather than figuring that out for yourself, there are a number of calculators out there on the internet. In this case, I'm going to go ahead and choose the NerdWallet calculator. And I've just plugged in some numbers here randomly. We're going to take a $100 Treasury bill, and let's say that the interest rate goes down to 4%. And the time to maturity, if you had purchased it at the beginning of the year, you'd have roughly about 27 weeks until the end of the year. Hitting all of these variables into here, you'll come up with a price of $97.90. Now, if you wanted to know how much more money you would make, you would simply subtract the amount that you paid for your Treasury bill from the new price of your Treasury bill, and that's how much money you would make if you were to sell your Treasury bill. There is another way to go ahead and calculate this, and that's using the Treasury bill function in Excel. In this case, I've plugged in all of the data here, and you'll see that we come up with a price of $97.88. Now, if you want to know how to get to this formula, you simply type in =, and T-bill. And when you do that, you're going to be given a couple of options. If you want to know the price, you're going to click on price. If you want to know the yield, you're going to click on yield. You will notice that the price was just a little bit different, and just realize that this calculator is using maturity in weeks, and in Excel, you would be using it in the number of days that are left until maturity. So just slightly different, but close enough for government work, as they say. If you want to know how to calculate the new price on your Treasury note or bond, you could use a rather extensive formula, which I won't belabor you with, or you can simply go to one of the many calculators that are online. In this case, I've chosen Fidelity, and I've gone ahead and input some variables here. We'll say that we started out with a coupon rate of 4.25%, but after interest rates go down, the current Treasury notes would be paying 4%. And we've made this go out roughly 10 years with a purchase or a settlement date of April 1st and maturing in 2034. When we hit calculate here, we're going to go ahead and get a price for the new price for our bond, if we wanted to sell it, or Treasury note, would be $102, even though we only paid $100 for it. And again, if you wanted to use Excel, you could go ahead and plug in the bond formula. In this case, you would type in =, and price, and you'll notice that you would click here, and it will give you all of the variables that you would go ahead and put in. In this case, we see price, settlement, maturity date, the interest rate, what the yield is, what the redemption value is, or the face value or par value, how often it pays, and then the basis, which is 360 in this case, because the Treasury uses a 360-day year instead of a 365-day year. It's an accounting thing. And in this case, we come up with a price of $102.04. That leads us to question number 4. What happens to the yield on your bond, the yield to maturity? If you don't want to sell your Treasury bill, note, or bond, the yield to maturity will stay the same. However, if you're interested in buying a Treasury bill, note, or bond on the secondary market, or you're interested in selling the current Treasury bill, note, or bond that you hold, you may be interested in what the yield to maturity is. In order to calculate that, you can simply change this to yield on here and use the data that we entered before. I'm not going to go ahead and type all of that in, but you would do a similar process. Or you can also use Excel. In this case, you would go ahead and enter that =, T-bill again, and simply choose yield. Then you would put in the variables that it's asking for: settlement, maturity, and price. And I've done that in this cell. We come up with the yield to maturity is 4.09%. Similarly, you can do that for a Treasury note or bond. You would simply type in =, and yield, and then choose yield there. And again, it will give you all of the variables that you would want to input in order to calculate your yield. So in this video, we've answered the main question: what happens to my Treasury bill, note, or bond should the Fed decide to lower interest rates? We've done that by asking 4 additional questions relating to. So in this video, we've answered the question: what happens to my Treasury bill, note, or bond if the Fed decides to lower interest rates? We've done that by asking 4 additional questions and providing answers to: is it possible for the Treasury to make you sell your Treasury bill, note, or bond? The answer to that is no, they're not currently callable. We've answered what happens to your coupon payment. That would remain the same. We've answered what happens to the price. If the Fed lowers interest rates, the price of your current Treasury bill, note, or bond will go up. Now, I need to explain that a little bit, because keep in mind that if you own a Treasury bill, note, or bond that is paying an interest rate that is lower than what the new interest rate would be, your price will go up from what it is today, or from what it is right before the interest rates change. It won't go up to the full face value of your bond until interest rates come down to that same level. And then we talked about what happens to yield to maturity. It will stay the same. And if you're interested in buying a new Treasury bill, note, or bond, you'll want to pay attention to what the new yield to maturity would be on that bond. You'll also want to pay attention to what the coupon payment will be, particularly if you're doing this for fixed income. If any of this was worth it to you, please give us a thumbs up. Congratulations for making it to the end of the video. And until next time, enjoy your investing.